Hello friends, and welcome to this video of Accounts Made Easy. And in today's video we are going to start with marginal costing. Please understand, marginal costing is one of the most important topics or the concept that you people need to learn in either cost accounting or what we also call as managerial accounting. So in today's class we are going to deal with the formulas which we are supposed to use to solve the questions of marginal costing. To start with, we are first going to discuss about the most important one, which is called marginal costing equation. What is this equation? Simple one, but quite effective and quite important. The equation is sales minus variable cost is equal to fixed cost plus profit, which is equal to contribution. As abbreviated, you can see it is S minus V is equal to F plus P, which is equal to C. Understanding this equation will help us to understand all other concepts of marginal costing in a comparatively easier way. But then, just by looking at this formula, let's not do it. Let's take a numerical example to understand how actually the marginal costing equation works. So let's take an example. It says sales. Now let us say that my sales is 100 minus I have to deduct variable cost. So say my variable cost is 60 rupees. Now what do I get here is my balancing figure of 40, which is called contribution. Okay, we have got our contribution. Now what we need to do is from this contribution we will be deducting our fixed cost. Let's say it is 25 rupees, and now the balancing figure that we get 15. This is exactly what we call as profit. And now look at this very carefully. If I do 60 minus 100, what I end up getting is 40. That is sales minus variable cost is contribution. At the same time, if I do 15 plus 25, still what I get is 40, which is profit plus fixed cost. Now this is exactly what I wanted you people to understand, that when you subtract variable cost from your sales or when you add your fixed cost and profit, the figure you get here is always the same, and this amount is called as contribution. As far as marginal costing is concerned, we are going to pay a lot of attention on contribution. So based on this, we have got two different formulas to calculate contribution. Let's look at them in a separate slide. Here it is. Contribution is sales minus variable cost. Now at this point, understand one thing. When I say sales, it may mean total sales or selling price per unit. Similarly, when we talk about variable cost, again this term variable cost may be variable cost per unit or total variable cost. And the next formula we have is fixed cost plus profit. Now this is where you need to understand. As far as sales and variable cost were concerned, I told you they can be per unit or total. But fixed cost and profit, they will never be per unit or total. Fixed cost is always total fixed cost. Obviously, in that case, the profit will also be the total profit or the net profit that we get. So there are two basic formulas that we learn on the screen. First, called sales minus variable cost, and the second one is fixed cost plus profit. Yes, understand this. If there is a loss, sir, what to do if there is a loss? Nothing better. We have understood that actually loss is a negative profit. So if there is a loss, all that happens is rather than adding profit, we will subtract our loss and we get the answer. Right? I hope we have understood this. So let's move to the next part then. The next part is the calculation of PV ratio. This is how it is very commonly known. However, the full form is profit volume ratio. With reference to this particular chapter, here when I say profit, we basically understand it as contribution, and volume always talks about sales. So in simple language, this is contribution to sales ratio or profit volume ratio. Now remember one thing, this ratio, the answer is always in percentage, and therefore if you look at any formula, it will always be multiplied by 100. It will always be multiplied by 100. The reason is the answer that we want is in percentage. PV ratio is always a percentage answer. Okay, so let's look at the first formula. It's the simplest one, which says contribution by sales into 100. The name itself says profit, that is contribution, volume, that is sales. The name itself says contribution to sales ratio. So contribution to sales ratio, we have got this. Now, if you remember in the previous slide, we learned two formulas for contribution. That is exactly what we are applying here. Sales minus variable cost by sales, or fixed cost plus profit by sales. Two different formulas to calculate contribution. They are simple. The next one is important. It says PV ratio is 100 minus variable cost by sales into 100. If we have to understand this in some other terms, let's understand this. It would mean that the percentage of variable cost plus PV ratio should be equal to 100. Why it is like this? Let's have a look at this. Contribution to sales, which is 40 by 60. If I do it, it becomes 40 by 60. Similarly, if I have to do my variable cost by sales, it will become, here it is 100, and here it will become 60 by 100. Look at this carefully. 40 plus 60 is 100. And that is the reason why this formula, it says 100 minus variable cost by sales, which is the percentage of variable cost to sales. So remember, PV ratio plus variable cost ratio is equal to 100. Okay, and the last one, before we go for the last formula, remember this formula can be used only when we have the data for two different periods, say 2019 and 2020, or some other information. If we have data for two periods, then we use the formula, which is change in profit by change in sales into 100. Okay, the top four formulas, we use it in a single year period, or the last one, we use it only when we have a two period data. All right, so these are various formulas for PV ratio. Remember, in almost every given question of marginal costing, we would need to calculate contribution and PV ratio. All right, now let's look at the next one, which is called a break-even point. Before we go for the formula, let's understand what do we understand by the term BEP, which is a break-even point. Okay, so a break-even point means that point of sales where we have no profit, no loss. I'm sure you have learned this particular concept in economics, and that is exactly the same thing. BEP is that sales level where there is no profit or no loss. Okay, let's continue with this example. Imagine a situation where I say if my fixed cost was 40, then what would be my profit? 0. Which means this 100 rupees, what we are seeing here, the 100 rupees, this becomes my break-even point. Any point of sales where my profit is 0 is called my break-even sales. Now, if you look at this particular thing very carefully, you would realize one thing, which is absolute common sense. Any sales where contribution is equal to fixed cost, that becomes your break-even sales. So you people need to remember, at break-even point, our contribution will be equal to our fixed cost. Because if I decrease my contribution, say back to 25, I end up getting a profit. Similarly, if I increase my contribution, I end up getting a loss. Right? It is only if my contribution is equal to fixed cost, I would get my break-even point. That means if I get this 40, I get answer here is 0. And based on this, we have all the formulas to learn. But before we start with the formulas, you people need to remember one thing. Break-even point can be calculated either in the number of units or in terms of rupee value. That is what we call as rupees amount or value. Okay. And one important thing that you people need to remember, not only for break-even point, any calculation that you people have to do, if you want your answer in units, divide the equation by contribution per unit. If you want your answer in rupees, divide the equation by PV ratio. Now look at this. If I want my BEP in units, fixed cost divided by contribution per unit. Same thing, if I want my BEP in value, I can calculate in two ways. One, I copied on the same formula so that I get my BEP in units and then I multiply it by selling price per unit. Another smart way, simply fixed cost is divided by PV ratio, that's it. If you want an answer in rupee or value, you just have to divide it by PV ratio. This is how to calculate BEP in units or value, that is rupees. But if you want to calculate BEP in percentage, there are three different formulas. It is fixed cost by total contribution. Please remember, in units, we divide it by contribution per unit. I want answer in percentage, I divide it by total contribution. The next is BEP in rupees to be divided by total sales in rupees. What percentage of my total sales is my BEP? As simple as this. And the last one is also repeat. Value becomes units and you get the answer. For us, remembering the first formula is important, examination point of view. Okay. Okay, now let's look at the next one called margin of safety. But before we start understanding the formulas of margin of safety, first let's try and understand what is margin of safety. Let's take an example. Say my sales are rupees 20,000 and my break-even sales, which is also called as my break-even point, say it is 15,000. So when we look at the difference between both of them, we understand that we get a difference of 5,000. This 5,000 is called as margin of safety. Now a lot of students ask me, sir, what is this? Guys, understand this, very simple. To make sure that I am not suffering any loss, I would need to make the sales of rupees 15,000. Anything I sell beyond 15,000, that gives me that cushion, that safety, that okay, if my sales decrease by this amount, still I am safe, I will not incur loss. And therefore, any sales which is beyond my BEP sales is called as my margin of safety. Now, let's go back to the slide and have a look at the formulas. Again, exactly similar to how we did our BEP, even our margin of safety can be calculated in units or in value. Okay, that is in rupees. So, if I want to calculate it in units, it will be actual sales in units minus break-even sales in units. Same word units, when I substitute by the word value, it becomes actual sales in value minus B sales in value. However, formula, pay attention to the formula. If you remember, I told you that if I want the answer in rupees, I divide by PV ratio. And I want the answer in units, I divide it by contribution per unit. That's applicable everywhere, even here. It says margin of safety in units is profit by contribution per unit, or margin of safety in value is profit by PV ratio. Simple. We just need to remember answer in units divide by contribution, answer in rupees divide by PV ratio, or margin of safety in units into selling price per unit. That's standard, common sense. All right. So now let's look at the next part of margin of safety, where we calculate margin of safety as a percentage of sales. Guys, these formulas are going to help us in solve quite a few problems. Okay, so the first one is simple, margin of safety by actual sales. That is, if my actual sales is 100%, then what percentage is my margin of safety? That's how we calculate it. Now, because we are trying to find the answer in percentage, obviously we need to multiply the formula by 100. Okay, the next one is same formula. This is in units and this becomes rupees. That's the only difference. However, this formula is important for us. Profit by total contribution into 100. This is a little different formula that we are using, and we need to remember this. Profit by total contribution into 100. gives us exactly the margin of safety as a percentage of sales. And the last one is again a little bit of common sense. It is 100 minus break even sales in percentage. Let's go back to this and have a look at this. If I say that my sales are 100% and my break even sales are 75%, automatically my margin of safety sales will become 25%. How did I get this? Sales minus BEP, and we need to understand that BEP plus MOS is 100%. BEP plus MOS, 15,000 plus 5,000 is 20,000. That's how this last formula has been created. 100 minus B sales in percentage, we get this. All right. So let's look at the last slide of this video where we learn the formula for required sales. What happens is a lot of times in some questions they do ask that, okay, if the business desires to earn X amount of profit, then to earn this profit, what is the sales they need to make? So the formula is again simple. It is desired profit, that is the profit that the organization wants to earn, plus fixed cost. That remains fixed. Now, depends whether I want the answer in units or I want the answer in rupees. If I want the answer in units, I divide it by exactly contribution per unit. And if I want the answer in rupees, I would have to divide it by P ratio, right? So guys, that's it from my end in this video to make you people understand the formulas. What we are going to do is in the next class, we'll start solving with the questions on marginal costing. Till then, thank you guys. Take care. Bye-bye.